It started with a promise, a big, beautiful tax plan that Donald Trump said would make America's finances fair again. For most people, that sounded like lower taxes, more money in your pocket, and fewer headaches every April. But for one specific group of high earners, something went terribly wrong, because buried deep inside that shiny new bill was a ticking time bomb that no one saw coming. A hidden clause that could quietly cost upper-income families tens of thousands of dollars a year. It's being called the SALT torpedo. And here's the twist. It's not targeting billionaires with private jets or offshore accounts. It's aimed at the upper middle class. Doctors, small business owners, professionals who worked their way into the $500,000 income range. The people who thought they were safe. They're now discovering that the very bill that promised relief has turned into their biggest tax nightmare. One accountant even called it the most unfair trap in the entire tax code. So what exactly is this SALT torpedo? Why are some high earners suddenly paying more than before, even with tax cuts on paper? And how can you avoid getting caught in it? Let's start from the beginning, with the tax break that was supposed to make everyone richer, but instead left thousands wondering if they'd been played. When Trump's tax overhaul passed, it came wrapped in patriotic branding, a victory for the American taxpayer. The headlines focused on the SALT deduction, short for state and local taxes. It's a long-standing benefit that lets taxpayers deduct the amount they pay to state and local governments from their federal tax bill. Before Trump's new bill, the cap for that deduction sat at $10,000, a limit that especially hurt residents of high-tax states like New York, California, and New Jersey. So when the 2025 reform raised that limit to $40,000, it sounded like a gift. More breathing room for high earners, more savings for those paying steep state taxes. But what most people didn't notice was the fine print. Starting at an adjusted gross income of $500,000, that new $40,000 deduction doesn't just stop growing, it starts disappearing. Every dollar earned above that threshold triggers a 30% phase-out of the benefit. In plain English, if your income crosses the $500K line, you lose 30% of your deduction for every dollar above it. And by the time your income reaches around $600K, the entire deduction is gone. That's why tax professionals are calling it the SALT torpedo. It looks harmless at first, even generous, until you cross that invisible line. Then suddenly the numbers flip. You're earning more but keeping less. Your tax rate jumps faster than you can believe, sometimes hitting an effective rate as high as 45%. To put that in perspective, some billionaires, with their private foundations, deferred income, and complex deductions, end up paying a lower percentage in taxes than these professionals caught in the SALT blast zone. And here's the kicker. The IRS didn't hide it. It's all there in the public text. But buried so deep, even seasoned accountants missed it the first time around. It's a trap disguised as a tax cut. And the people walking into it aren't the ultra-rich. They're the ones who thought they'd finally made it. Imagine this. You finally crossed the $500,000 mark. You've spent years building your business, working weekends, managing employees, paying your dues. It should feel like victory. But instead of celebration, you open your tax bill and feel sick because every extra dollar you earned beyond $500,000 is now punishing you. Accountants call it the torpedo zone. It's where income between $500K and $600K triggers an invisible penalty. A phase-out so steep it can push your effective tax rate above 45%. Not because of bad investments or reckless spending, but because of one line of policy buried inside a 1,000-page bill. You see, the new SALT deduction was supposed to reward high taxpayers in expensive states, people who already shoulder big local tax burdens. But as Robert Keebler, a CPA who first broke down the numbers, put it, those with adjusted gross income over $500K will be subject to an unpleasant phase-out that increases their effective tax rate by 30%. So instead of saving $30,000 under Trump's higher cap, these earners lose it instantly, the moment their income creeps past that threshold. It's like climbing a financial ladder where the next rung breaks as soon as you step on it. And here's the irony. This hits hardest in the very states that already pay the most taxes. New York, California, Illinois, New Jersey. Blue states, filled with professionals who thought they'd be safe from sudden tax traps. For some, the result has been shocking. High-income earners have found themselves paying more in federal tax this year than they did before Trump's so-called cut. Some call it a stealth hike. Others say it's political payback. Either way, the outcome's the same. You work harder, you earn more, and yet somehow you end up with less. And as one financial planner put it, that's not a tax system. That's a punishment for success. But if you think this was a mistake, just wait until you see who benefits from it. Here's the uncomfortable truth. The SALT torpedo wasn't an accident. It was a design choice. It wasn't written to target billionaires who have armies of tax attorneys and offshore shelters. It was aimed squarely at the upper middle class, the professionals, entrepreneurs, and dual-income families who sit between ordinary Americans and the ultra-rich. Why? Because they're visible, taxable, and stationary. They don't have shell companies in the Cayman Islands. They don't get paid in stock options. They earn real income, salaries, profits, bonuses, all traceable and fully taxable. When Trump's economic team raised the SALT deduction cap to $40,000, it sounded generous. But the phase-out starting at $500K ensured that the people most likely to use it, high earners in big coastal cities, would never fully benefit. Think about that. Billionaires like real estate moguls or hedge fund titans, they're unaffected. Middle-class families under $200K, not even close to the threshold. But the comfortable class, lawyers, surgeons, tech founders, business owners, they're the ones who get caught in the crossfire. And the numbers don't lie. According to financial analysts, someone earning $550,000 in New York could now pay thousands more in taxes than someone earning $480,000, just because they crossed that invisible line. That's why experts call it a cliff effect. You don't ease into it, you fall off it. Critics argue it's a way to squeeze extra revenue from people who can't easily escape. They earn too much to qualify for middle-class breaks, but not enough to restructure their wealth like the top 1%. It's a political sweet spot, where the government can collect billions while still claiming it's taxing the rich. But here's the irony. Even as it punishes high earners, the policy looks fair on paper. Most Americans hear $500,000 income and think, you're doing fine. What they don't see is how that bracket now bears one of the steepest marginal tax spikes in modern U.S. history. And while Trump's team calls it balanced reform, financial advisors see it for what it is, a slow, quiet redistribution of tax pain. So the question becomes, can you actually fight back against it? For most high-income earners, the SALT torpedo feels like a trap with no escape. But for the truly strategic, there are still hidden doors. Because while the tax code takes with one hand, it quietly gives with the other. The ultra-wealthy already know this. They hire tax architects, not just accountants, who specialize in bending the rules without breaking them. And now financial planners are revealing the same playbook that keeps the richest Americans below the torpedo zone. Here's how it works. 1. Lower your visible income. The first move is psychological, not financial. It's about reframing what counts as taxable income. Instead of taking big end-of-year bonuses or selling appreciated assets, the wealthy defer. They use deferred compensation plans or restricted stock units, which push income into future years. The goal? Stay just below that $500K adjusted gross income, AGI threshold, the tripwire that triggers the SALT torpedo. 2. Switch from mutual funds to tax-efficient ETFs. It sounds simple, but it's a quiet power move. Traditional mutual funds often distribute year-end capital gains that inflate your income. ETFs, on the other hand, are built to avoid those taxable distributions, letting you grow your wealth without tripping the IRS alarms. 3. Invest in real estate with a 1031 exchange. Real estate moguls love this one. Under IRS Code 1031, if you sell a property and reinvest the profits into another like-kind property, you can defer capital gains taxes indefinitely. It's perfectly legal, and it can drop your taxable income well below the danger zone. Even firms like First National Realty Partners (FNRP) now let accredited investors buy shares in properties leased to giants like Walmart, CVS, and Whole Foods. These deals often qualify for 1031 exchanges, giving investors big returns and powerful tax shields. 4. The charitable strategy. Some high earners are donating more, not just for goodwill, but for efficiency. By strategically timing large charitable contributions, they can bring their taxable income below the $500K cliff while still supporting causes they care about. 5. Timing is everything. Financial advisors are now modeling multi-year tax projections to help clients plan ahead. That means selling assets or realizing income in alternating years, keeping the IRS from stacking your gains all at once. As one planner put it, the code punishes short-term thinking. The smart ones are already playing the long game. But these strategies aren't just for the billionaires anymore. With the right structure and timing, even upper-middle earners can dodge the worst of the torpedo's impact. Still, every workaround has its limits. And as more people learn to exploit these loopholes, Washington is already looking for ways to close them. Because if there's one thing history has taught us, it's this. When the rich start dodging taxes too well, the rules change fast. The SALT torpedo isn't just a tax issue. It's a mirror reflecting how divided America has become over money, class, and fairness. When Trump signed his big, beautiful tax bill, his supporters called it a victory for working Americans. But in reality, it's created a strange new battleground, one where the upper middle class feels punished, the ultra-rich stay untouched, and the true middle class doesn't even realize what's happening. Politically, the optics were brilliant. On paper, it looked like a tax break for everyone. But strategically, it shifted pressure away from billionaires and toward the professionals who actually keep the country running. Doctors, entrepreneurs, engineers, executives. The people who earn a lot, yes, but who still work for their money. Critics call it stealth populism. It plays to the public's resentment of the rich while secretly sparing the ultra-wealthy, the ones with complex trusts and offshore shelters. It lets politicians say, "We're taxing the top," while quietly protecting those at the very top. And here's where it gets even more ironic. The states hit hardest by the SALT torpedo are the economic engines of the country. New York, California, and New Jersey contribute a massive share of federal tax revenue. Yet their high earners are now paying even more, while their contributions fund relief in lower tax states that often vote the opposite way. Some economists see it as a form of economic retaliation, a reshuffling of wealth from blue states to red. Others say it's a warning shot, proof that America's tax system is no longer about fairness, but about politics. But what no one can deny is this. The SALT torpedo has exposed just how fragile the promise of equal opportunity really is. Because for the first time, a group that's always felt secure, those making $500,000 and up, is realizing that the system can turn on them too. And if that can happen to the winners of the economy, who's really safe? Every major tax reform creates winners and losers, but this time, the divide is sharper than ever. The winners? They're the ones who already learned how to make the system work for them. Mega corporations with offshore subsidiaries, hedge fund managers who defer income through complex vehicles, real estate moguls who can write off depreciation while collecting rental income. These players aren't worried about phaseouts or deduction caps. They operate in a different universe, one where tax rules are a game to be mastered, not followed. And then there are the losers, the ones in the crossfire of the SALT torpedo. People earning between $500K and $600K, many of whom live in high-cost cities where that income doesn't stretch nearly as far as it sounds. They're not flying private jets. They're paying mortgages, property taxes, tuition, and trying to save for retirement. For them, Trump's cut became a surprise tax hike, adding thousands to their annual bill without warning. Some families have even started restructuring their businesses or delaying bonuses just to avoid crossing the SALT threshold. Financial advisors call it income engineering. The rest of us might call it financial survival. And here's the twist. While these professionals are losing ground, billionaires like Trump himself are likely saving millions through corporate deductions and depreciation loopholes. It's a paradox. The man who promised to drain the swamp built a tax maze that protects the biggest fish while trapping everyone just below them. The middle class doesn't feel it, yet. But the ripple effect is coming. As high earners cut spending and investments to offset their tax losses, local economies take the hit, from fewer home sales to declining small business revenue. As one Wall Street economist put it, the SALT torpedo doesn't just hit people's wallets, it hits their confidence. And confidence drives the economy. So who really won? The billionaires, the corporations, and the accountants who now have an endless stream of new clients. Who lost? The people who played by the rules and just happened to do too well. But here's the catch. This story isn't over, because every tax policy creates a backlash, and this one might ignite something far bigger than a fight over deductions. It started as a line in a tax bill. Now it's turning into a movement. Across America's wealthiest cities, from Manhattan to Silicon Valley, there's a quiet anger rising among the very people who used to believe they were untouchable. Doctors, small business owners, executives, people who built their way into success, are realizing that their reward isn't freedom, it's punishment. They call it the new tax class war. Because while billionaires celebrate record profits and corporations enjoy historic tax breaks, the upper middle class is being asked to pay the price for everyone else's relief. In private conversations, financial planners describe clients furious but helpless. They can't hide their income, they can't rewrite the rules, and they're too wealthy to be pitied, yet too vulnerable to fight back alone. That's how resentment begins. And history shows that resentment, when left unchecked, can reshape entire economies. Already, political analysts are warning that the SALT torpedo could trigger a wave of backlash in upcoming elections, especially in states hit hardest. If you take the nation's most productive earners, drain their resources, and tell them to smile about shared sacrifice, eventually they stop cooperating. And here's the irony. Trump's big, beautiful plan may have handed him a short-term win, but it could spark a long-term revolt. A revolt not of the poor against the rich, but of the successful against the system. The question isn't whether people will find a way around the torpedo. They always do. The question is whether this moment marks the beginning of something bigger, a reckoning with how America defines fairness, wealth, and reward. Because as history has shown again and again, when enough people believe the system is rigged, they stop playing by its rules. And when that happens, it's not just taxes that change, it's the entire idea of who gets to win in America.